Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Lobo Tiggre from the IndependentSpeculator.com. He's speaking to us from Puerto Rico. You can find him on Twitter at Due Diligence Guy. Welcome back to the show.
Happy to be back with you, Jim.
What has been the most interesting thing you've seen on the markets the past week or two?
What a broad question. And it's been a month since we've spoken. There's a lot that I could say, but I do actually have a top pick there. And to frame this properly, I need to back up for a moment. There's been all these, the unprecedented. We hesitate to use that word because it's so overused now, but it's true. There's so much that's been unprecedented, and that's even after all the unprecedented things of the crash of 2008. So truly historic times we're living through. Nothing new. Your audience knows that. My audience knows that. But with all this crazy stuff going on, I have had this just overpowering feeling that the divergence between Wall Street and Main Street was untenable. That it made no sense for disastrous report after disastrous report from the real economy to be a reason for buying stocks on Wall Street. And yet every time that seemed to happen, that's what we would see. I've got a folder full of images of negative headlines with stocks in the green above on my charts, on my screens, and it's just amazing. And I've been thinking for weeks that this is untenable, this can't last. Yes, I understand the government's printing all kinds of money, but reality is bad. And the companies, even if they're listed on Wall Street, should represent some aspect of the real economy. So you can't have a divergence between the real economy and Wall Street forever. That's been my feeling. And unfortunately, that was such a strong feeling, and it just seems so sure. It's hard for me to say anything is for sure. I resist making predictions, as you know. You never pin me down on what the gold price is going to be at the end of the year because I don't like making this kind of prediction. But this seemed like such a sure thing that Main Street and Wall Street could not be disconnected forever. I really I made a decision, and not so much a prediction, but I made a decision not to invest, not to take advantage of the opportunities that were available in March, waiting for the other shoe to drop, waiting for the next part of the crash to unfold. And that left me, I wasn't short. I didn't sell out and go to cash and lose out everything. But there were spectacular opportunities in March I didn't take advantage of. And I was waiting in April, they didn't come. And now, here in May, I have to say, I'm no longer willing to just wait for those opportunities. Now, let me be very clear. I'm not saying it's all clear, it's all safe in the water, no more sharks, get in there and swim your heart out. There is still certainly danger. I still think that Wall Street and Main Street can't diverge forever. And there is another clear and present danger of more meltdown. But I don't expect it at this point. Wall Street has shown just an astounding ability to shrug off the worst news or make it a reason to buy. So with that going on, and really with the Fed and Congress and other governments around the world doing similar things, I think I just have to face the data. The data is telling me that there's no reason to expect another meltdown in the nearest term. It will be a while before reality really asserts itself. And so that's the most interesting thing to me. This is something I wrote about last week in my free weekly digest. And I guess quick plug there, if anybody is not getting my Speculators Digest, you can come to the website, IndependentSpeculator.com, sign up. I promise you we won't spam you. If you sign up, you get one email per week, and that's it. No torrent of advertisements. And this is an idea that I've laid out for readers already, and I'm now sharing it with this broader audience. And the idea, again, to be clear, is I'm not saying it's perfectly safe to get back in the water. I'm saying that there's opportunities that one can miss out on, especially if there's an investment that you are highly confident of, and I have several, and there are time factors that, they may deliver the next drill results, or the next resource estimate, or whatever the deliverable is in the near term. Well, I'm not going to wait for another meltdown before getting on board, because I could miss out more opportunities. So that's my insight for this week and this month, Jim.
What has been the hottest performing metal so far this year?
Well, I'm not going to make any friends saying this. Well, maybe in some quarters, but it's not gold as much as I'd like to say that. I'm a big fan of gold, and it's where I put my savings. It's very high on my shopping list of stocks that I want to buy, gold stocks, and silver too, because it follows gold and ultimately usually performs higher. But really the hottest metal of the year is uranium, and it's it's one of those things where we've talked about uranium. You and I have talked about it many months, and uranium bugs have been talking about how strong the fundamentals are and how you can't mine the stuff at current prices and it has to go up. The problem with that story is that it's been true for years, and the prices have just sort of waffled around, though really they have actually been rising over the last 3 years, but anemically and not above the cost needed to make money for miners. And what's happened this year is that it's not just the COVID-19 situation, though the COVID-19 shutdown did affect the world's biggest, richest uranium mine. Cigar Lake, Cameco's flagship project, was shut down. But interestingly enough, when they shut it down, they didn't say, we'll reopen it as soon as we can. They said, we'll see. And then after the weeks prescribed passed, they said, well, we're still seeing. And there's no actual time frame at this point for reopening that mine, which supplies about 13% of the annual demand, that one single mine. And this is after they had shut down their number 2 operation, which is also huge and high grade. And after Kazakhstan, the world's lowest cost producer, had scaled back production. And Kazakhstan has also announced, rather more vaguely, that they expect to produce significantly less uranium this year because of the COVID-19 situation. From the numbers, it looks to me to be about a 16% reduction on top of their already reduced output from previous guidance for the year. So what I'm saying here, and again, try to be clear as I can, because it's more than just the COVID-19 situation. It's not just, COVID-19 shut down, high prices. If that's all it was, it would be bad, because as soon as you open back up again, then prices would plummet again. What I'm saying is you had a market that was in structural supply deficit from the mining side. It was suffering from secondary supply coming online from Japan and other places. But the mine supply hasn't been enough to meet demand for many years. And it seems that the secondary supply has stopped coming on the market recently. And on top of that, then you got this COVID thing. So again, pin meets balloon type situation. And prices just rocketed up. Week by week they've gone up. They're a little bit off this week, which is normal, but we're still above $33 a pound, which compares very favorably to $24 a pound not so long ago. Again, that's not enough for the miners to make money, but it's a lot closer to where the lower cost miners can make money. And the uranium stocks have done terrifically. Many of them have tripled over their March lows. And if there is a pullback in the near term, I would see that as a buying opportunity.
We'll have more with Lobo Tiggre right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Lobo Tiggre. Lobo, the U.S. Fed says it will not look at negative interest rates. They'll stay at zero in the U.S., 0.25% most likely in Canada. What does that do to the money supply and for the markets overall?
Well, it's an interesting question to see what happens there. In a way, they've sort of painted themselves in the corner, and of course they have to say that. But the bond market is saying that they will go there. And if they disappoint bond investors, that has its own consequences. So they're kind of damned if they do, damned if they don't. The implications of the world's reserve currency going there, I think, are different than for other countries. And that can become a very long, involved economic conversation. But I think maybe let's just take a step back and say that whether nominal rates go negative, real rates are negative. And this has profound implications already for investors, and particularly for gold. Investor may not be the right word, but gold investors, gold speculators, and just people who, like me, put their savings in gold. Because the long complaint against gold for all these years has been, oh yeah, but gold doesn't pay interest, so why own gold? Well, now something that doesn't pay interest and may actually become more dear in times sure sounds a lot better than a guaranteed loss in a government bond. So it'll be potentially some interesting fireworks, and I don't care to predict which way it'll go, if they do, if they don't. But I think either way, it's good for gold. If they go negative, that really is sending up a flare saying, you know, the economy is in real trouble, things are much worse than you think, and that's very bad, and that would be good for safe haven assets like gold. And the interest thing would also be good for gold. But if they do go there and they do provide that extra liquidity and extra bailout, you know, that kind of says the same thing, you know, one way or the other. If they don't, and they upset the bond market, there's more fireworks that way. So I see it as a win-win for gold and ultimately silver as well.
We'll have more from Lobo Tiggre right after the break.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Lobo Tiggre. Do you expect agricultural stocks to go up as more and more people talk about the importance of a secure food supply, because we've seen supply chains snapped and some completely broken after this virus crisis?
Yeah, a lot of people ask me about agricultural products because my teacher, my mentor in years past, Doug Casey, is a big fan of the agricultural sector when it's cyclically low. And he personally has herds of cows in Argentina, and he likes the ag sector as anything else that's highly cyclical. So a lot of my readers ask me about this, and I have to say I've never been a cowboy, and I've never been a rancher like Doug, so I have less personal knowledge on this. But it is really noteworthy in the last inflation statistics and wholesale statistics. I noticed, you know, the prices were down. There was a definite deflationary appearance in the numbers. But mostly that was due to lower oil prices. Of course, the overall number is down if oil goes negative or then just gets, you know, much cheaper and stays there. But at the same time, within that, when you tease it apart, food prices were up. And that is not surprising given the disruptions to the food chain. Now, is that sustainable? Is it going to stay that way? I don't know. If herds went into liquidation, if crops were plowed under and there was going to be a serious food shortage, this year in the first world, then yeah, I would say so. But I don't know that we're really at that case. You have dairy farmers famously pouring millions of gallons down the drain, but the cows still produce milk. And if the government bails them out, it may actually not disrupt all that much. And fortunately for things on the plant side of the world, of the agricultural sector, we haven't really started planting that much in the northern hemisphere yet. I think up there in the Great White North where you are, I don't know if you've even got the snow melted yet that much. I don't know when the farmers plant in Saskatchewan, but I would guess that they're not anywhere near having to worry about plow crops under that they can't sell. So I would not yet say that there's going to be a huge train wreck in the food supply. But clearly the disruptions have been enough already to impact food prices. It's something to watch for. And you may say, well, Lobo, what good is it if you don't know? If you can't say one or the way or the other, well, it's not my expertise, but I will say that one way or the other, either the bailouts and the government assistance smooth things over and the food supply stays whole, yay, that's still good for gold. Sorry to come back to my favorite metal there, but it's still good for gold. All that money printing and helping comes at a cost. And if things go bad, if there is a major disruption and people can't get the food they want on the shelves, then you have another major headache and a problem and potentially social unrest. I mean, that's serious stuff when people can't put food on the table. That's good for gold, too. So I'm sorry if I sound like a one-track mind here, but many of these disruptions that I can't predict the future on, it seems like a win-win for gold no matter how it plays out.
I was going to say the one big difference, because we talked about gold and uranium, is you can store gold under your bed. I don't know if it's a good idea to store your uranium there.
Of course not, and that's different. But there is a commonality here. People, and it's not the color. People call uranium the other yellow metal. It's not. It's actually uranium oxide. So it's not the metal itself. If you ever had purified uranium and looked at it, it would be sort of grayish. But what's interesting here is that they're kind of contrarian in a way. Not really the same way. Let me retract that. Let me just say, I think both of them look really good this year, almost regardless of what happens with the economy. For gold, it's because it's a safe haven asset, it's something that you go to in times of trouble, and it's a monetary metal, so it's something that competes with the U.S. dollar and all the other currencies around the world. So when those are being debased, then that's good for gold prices. So gold looks good this year. Uranium is not the same, but it's not like copper or oil that suddenly people just stop using it when industry contracts. Uranium is used for baseload power. It's the power that keeps the lights on at night for cities. It's what you want for hospitals and important things that you have to have an uninterrupted power supply for. It's not exclusively like that, but it's predominantly, that's its use. That's where uranium shines, is always on, always ready, stable baseload power. And, unless we go back to a dark age, people are going to want the lights to come on at night. They're going to want to cook dinner. They're going to certainly want their hospitals to have plenty of light. So demand for uranium, I think, is much more durable, even in a substantial downturn, even in a greater recession, potentially even through a depression, than other energy minerals would be. And so if you have a stable demand at a time where supply is constrained, then it makes sense for prices to go up. So I'm bullish on both this year.
Lobo, what about the disruption that we're going to see major companies like Twitter saying people who are working at home likely won't ever be coming back to the office, or they'll be very slow to come back? And those little offices or businesses in those office blocks, the food shops, the clothing stores, what happens to them? And could that disrupt the economy, or just see the economy move places? They said it would be horrible for buggy makers when the automobile came along, but they turned to making automobiles.
Right, like the famous petition of the candle makers that wanted the sun banned. It obviously is a major impact. The real question here is, what's the permanent change going to be? Everybody's working from home, and there's a lot of news stories about companies saying, We're not going to pull people back in our offices. People are just as productive as home, or even more productive at home. So why do we need this expensive office space? That makes a great headline, and I'm sure there will be some of that, but it remains to be seen how big a trend that is. If in fact that turns out to be a major permanent change, and I could see it. I could absolutely see a large business, you pay all this money for office space where people come and hang out in the water cooler and play solitaire on their computers when the boss isn't looking, and then they can give each other germs. Like, who needs that? So I could see it happening, but I would just caution the audience to not assume that all these catchy headlines about these trends, it's too soon to say. Don't take the headline as a fait accompli. That said, given that our focus here tends to be on resources, it seems to me the one most predictable consequence of this would be, besides commercial real estate changes, would be on the oil patch. If there is a permanent, major change in consumer behavior here, in work habits, then all that morning commute, millions and millions of cars breathing in and out of the city every day and evening, it doesn't have to go away completely. It doesn't have to stop entirely. If it just shifts substantially, that has a major, major impact on oil demand permanently. That is something to watch for.
Mm-hmm. And of course, they tell people, well, get out of your car and use transit. Now the transit systems are going broke because nobody's using transit either. Would they?
That could actually be a countervailing factor, Jim, if you think about it. Okay, less people want to commute. But the people who do want to commute, they don't want to sit in a train car packed with 100 other people all breathing, their steamy air in the winter, passing their germs around. If there's a substantial preference change on that score, you could actually get more people in their cars or on their bikes if it's close enough. Again, these trends are developing. I think it's too early to say this is what will happen. But I'll tell you what, even if you get some people out of the trains and into cars, overall, if the net is fewer people going in and out of the city, it's going to take less energy to move those people, whether it's mass transit or individualized.
Lobo, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Lobo Tiggre from the IndependentSpeculator.com. He was speaking to us from Puerto Rico. Find him on Twitter at Due Diligence Guy. If you have any questions for Lobo or any of our other guests, you can send them to info@howstreet.com. Our Twitter handle is @HowStreet. Our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.